Hi, today we're talking with Nick Arreola, a PhD at Omaha's own Creighton University, where he is a director of data engineering. And the topic today is behavioral finance. Now, Nick, we know behavioral finance is not necessarily a new concept, but it is getting a lot of promotion, a lot of buzz in the industry right now. So for our viewers out there, can you just talk a little bit about what behavioral finance is and I guess in the end, are humans rational investors?
Sure. Great question. Great way to kick this off. So, behavioral finance is, there are lots of different definitions of it, but really the way that we think about it is how social, cognitive, emotional, and personality, as well as attentional limitations, influence investment decisions.
Sure.
And to your question, are humans rational? I think we have good intentions to be rational. Unfortunately, we have a lot of forces that are working against us. I think an interesting example of that is that we tend to look at gains versus losses very differently. So using a traditional example in behavioral finance research, if you look at someone who gains $50 versus someone who gains $100, and then that person loses $50. Well, in both situations, the net gain is $50.
Sure.
But if you look at that experience and you ask each person about that experience, the person who had the $50 and then had the $100 and lost $50, would experience that very differently. They'd be more upset, even though the net outcome was
the same, basically.
Was the same, exactly.
Yeah, so it happens a lot when we get market corrections or market crashes. We see a lot of people getting emotional about it and wanting to pull their money out. So definitely a big, what we call in the industry, behavior gap between returns that you should be getting and could be getting between what you're actually getting because you are getting emotional. So, so we talked a lot with the cognitive biases and why is this particularly important to investors to understand that they have these inherent biases? We can't necessarily control them, but maybe we can try to identify them and predict them and get better at them.
Yeah, I think that it's having awareness about these cognitive biases and other factors that can play a role are important because it really helps us customize, I think, our experience with clients. And so if I know that a client is likely to perceive a risk one way or a gain another way, that can help me in how I frame and tailor the consulting experience.
Right. Now, I just had a question. My favorite, well, not favorite, we all have biases, but one of the ones I find most interesting is hindsight bias, which maybe is like a subset of other biases, but it's just looking at past events, realizing you thought you could predict them when you really can't. So I don't know if you have a personal favorite or one you find the most interesting at all?
Yeah, I do. I've always been fascinated by the confirmation bias. So confirmation bias refers to when a person holds a position or they have a certain belief system, any information that conforms to that belief system, they accept almost automatically.
Sure.
But if they come across information that does not conform, they automatically not only do they reject it, but they're much more critical. So they'll question the methodology and whatnot. So I've always thought that one was pretty fascinating.
Yes. You're always seeking out information that agrees with your own perception.
Yeah. So from a persuasion perspective and trying to change somebody's mind, feeding them information alone won't necessarily be effective. You have to appeal to someone on other levels, such as, again, the emotional, personality, psychological level.
Sure. Yeah. No, that's a great point because it kind of brings me to the next question here. Like, what is CLS, with your direction, doing different with our studies than you may have seen with other quote unquote white papers or industry jargon out there?
Yeah, I think what we're doing, what CLS is doing, is really exciting and cutting edge. So traditional work in the area of behavioral finance really focused on cognitive biases, which have informed us quite a bit. But they're really limiting in a lot of ways in that we all engage in those in those cognitive biases. So we're all systematically irrational, and so we don't get a lot of great human variance, if you will. So which, when it comes from identifying different types of clients, is challenging. And so what CLS is doing is going beyond just the traditional behavioral finance view and looking at other factors, again, as I mentioned earlier, the social factors, the emotional factors, motivation, personality, and so forth. So I think CLS is really, really building on a line of work that's established, and I think that doing some really unique and cool stuff.
Good. So one of those was we talked about earlier at our investment committee meeting, in which you're a guest. So thank you for coming again.
Sure, my pleasure.
Was extroversion or introversion. So you mentioned in the paper in the study, extroversion can be more of a person if they're extroverted. Maybe they're happy to be out there in society, and they're more interested in like short-term thinking or being riskier. Is that true?
Sure. Yeah, short-term thinking, riskier. So. They're probably going to sell much more quickly than someone who is an introvert. Sure. The research is still growing, but that's the trend that we're seeing.
Awesome, awesome. So we work with financial advisors, and we are a financial advisor ourselves, a registered investment advisor. What roles as we shape this throughout the year do you see the end financial advisor having and CLS having as we kind of near the end of the year with completion steps? Sure,
I think. Again, it goes back to that awareness, being aware from an advisor's perspective of these different factors that play a role in the experience of advising clients. And so I think by being able to connect with clients on a more personal, custom level will be very beneficial because we know that just feeding clients information alone is not likely to be super effective.
It's not going to help change their decision in the heat of the moment. When you get emotional, you're maybe making a wrong decision, but it's still tough to change that behavior. So all of us have a lot of work cut out for us, I guess you could say, to help change it. But no, that's interesting. Kind of wrapping up here, what is the one thing you find the most fascinating? I know we talked about the bias, but just in general, the most fascinating with the study so far that you thought really popped out to you?
Sure. So I think this is fascinating because we really didn't observe it in the literature review that we've done and some of the discussions that we've had prior with behavioral finance professionals. So so we've conducted focus groups with a series of advisors, asking them about their client experiences. And one of the observations that emerged across all the focus groups was the importance of a client's identity. So we all have these different identities. So some folks identify as a parent, some folks identify as wanting to have that high wealth status. And so by being able to tap into those different identities can help us understand a lot about clients. And so especially from a motivational perspective, understanding what makes them tick, ultimately understanding their value of financial resources and why they're investing. So being able to appeal to clients on a personal level that gets at their identity, I think could be really effective.
Awesome. Well, thanks for coming in again. It sounds like we got a lot of good groundwork laid to try to predict it and hopefully change individual client behavior. So thanks again for coming in. And for all the watchers out there, we're going to have more on this on the CLS blog, of course. So thanks for watching.